everyone. We are entering the home stretch for the content portion of today. This panel does have slightly fewer hit songs between us than the next session does, but I think we are going to have a great discussion about the state of the alts industry. I am delighted to be joined by Boris, Vincent, and Todd to really talk about the highs, lows, and curiosities of living through quite a historic year. So why don't we start off, and each of you can introduce yourself, tell us briefly about your portfolio and the processes that go into your investment and risk analysis in this market.
Sure. Thank you, Shannon. My name is Boris Rakin. I oversee liquid strategies for the Bowdoin Endowment, which is about a $2.6 billion endowment for a liberal arts college that's up in Maine, but the team is based in New York. As far as the portfolio, we're not dissimilar from many of our endowment peers in that we're pretty broadly allocated across assets, including very much a bias towards alternative assets. I'd say the one area where we maybe differentiated from peers is that we still have a very large allocation to absolute return in the hedge fund space, where some of our peers are no longer there.
Well, good afternoon, New York. I'm Vincent Au, working for Alps Capital Management. It's a multi-family office based in Hong Kong. We serve about 14 family relationships, multi-asset, multi-manager approach. At a high level, there are 3 different types of strategies. If we look into different mandates, income focus, return seeking, and market neutral. But more recently, we do find more interest for market neutral strategies because of everything that's going on.
Todd Trabaco, StepStone Group. StepStone is an alternative specialist, hybrid consultancy and asset manager, total of about $700 billion in assets under management and advisory.
I want to get started by talking about something we spent a lot of time on our prep call discussing, and that's regional exposure. So can we talk a little bit about how you guys are thinking through regional exposure, particularly maybe U.S. asset and U.S. asset exposure?
Sure, I can start. So the U.S. remains a really important part of our portfolio and will likely remain the core part of our portfolio for the foreseeable future. But at the margin, we have been finding interesting opportunities in places such as Japan, India, and even alpha opportunities in emerging markets and peripheral Europe. So in addition to just seeing idiosyncratic, interesting bottom-up opportunities we do feel like it's important to have some level of diversification away from the dollar, given what's happening to some extent with foreigners that are kind of maybe rethinking both the level of hedging that they have in their US dollar assets, and then perhaps maybe at the margin thinking about repatriating some of those assets back home.
In terms of the US dollar exposure, for us, because we're based in Hong Kong, it actually means 2 things to us. One is obviously the investment opportunity set. It is by far the deepest and the biggest opportunity set you can find around the world. So that aspect is actually very important and is actually a dominant part for most of our portfolios. But the second part is because the Hong Kong dollar is also pegged to the US dollars. So naturally, any US dollar asset is also a liability matching asset for us. I think with everything that's going on right now, I think the latter part is actually have been a bigger topic for us to discuss with our clients in the recent times.
Right. So if we think about regional allocations, we think about US dollar versus foreign currency allocations, coming from the private credit perspective, we don't see that type of rotation. We tend to see more home bias and home country affinity. So you tend to see US investors, they'll have allocations globally, obviously, but their affinity will be for US denominated assets in their region. And I would say the same thing would go for a lot of other regions, although to a lesser extent, the US being the largest market. I also think that one of the challenges in private credit with respect to other regions is the rule of law. I think naturally the US, the Commonwealth countries, And some of the Nordics will naturally attract a bit more private credit capital because of the robust and proven regulations.
Vincent, I want to segue more towards strategies. We hit on regions. You are from Hong Kong, you're Hong Kong based. What strategies, either thematically or tactically, are your stakeholders interested in this type of market?
Okay, so one big topic that quite recently we've been talking a lot is about the USD dollarization. So to get around that problem, I mean, the simple way obviously is to find something other than the US dollar asset. But another way is more about focusing on what you can find in terms of the return opportunity set. So we do see quite a few market neutral strategy in the past. It hasn't been working it has been working pretty well in the past. Hasn't been working pretty well recently. So our focus is really about looking at our portfolio and seeing what we can do better. And one thing that we learned is liquidity. We need to strengthen a little bit more, and also we need to focus more about the leverage issue. So we do worry that if the unthinkable happen, what can it do to the portfolio for our clients. So capital preservation obviously is by far the more important. That's actually overall looking for greater opportunities right now.
And Boris, obviously you have to be a really long-term investor, and you mentioned you have a heightened allocation to absolute return strategies. Can you tell us how you're thinking about maybe navigating the medium to long term for your portfolio?
Sure. Yeah. As we think about longer-term strategies, in the allocation there, and also just thinking about the environment that we're in, sort of the changing, the dynamic nature of it, we're thinking of it sort of in two ways. One would be more at the manager level, one at the strategy level. At the manager level, we think that it's important for the managers we're investing in to have seen multiple market cycles and sort of be able to adapt accordingly, and also have the right toolkit. So thinking about perhaps one way is to think about from first principles about how you hedge your portfolios. And then at the strategy level, we prefer sort of strategies where managers think much more broadly across both geographically, but also across asset classes. So including FX, including rates, including commodities, and hopefully are finding both more asymmetric opportunities in these areas, but also able to hedge themselves better as markets are changing.
Yeah, pretty rapidly.
Yeah.
So Todd, obviously StepStone is a private market powerhouse. What does rotation mean in your world? Is it more reallocation? Is it pacing? How do you guys think about this?
Well, it can mean a couple different things. It can mean the increase of strategic allocations, which is, in a sense, a long-term rotation out of one asset class into another. So you might see an increased allocation to venture capital away from growth equity, or you might see an increase to private credit away from fixed income. So that's has a rotational element to it. You can also see tactical allocations, and I think the one last year that was the most noteworthy, most prevalent, was anything really in commercial real estate and CMBS. We saw a few managers come out with tactical funds that were going to take advantage of a market opportunity. You see that often. It's not only in CMBS or CRE. You'll see that in opportunistic credit. You'll see funds come to market that will capitalize on a period of distress or stress in the marketplace. In 2020 it happened, in 2018. And you'll also see preloaded funds like this, often referred to trigger funds or knock-in funds. Capital with a mandate that's been preset. Capital has been committed, and given certain triggers, it could be a blowout in spreads, it could be an increase in defaults, it could be a combination. At that point, the manager is then free to take capital, and as a result, the allocator will see its allocation, its portfolio tilt in that direction.
And you guys have pretty dynamic and differentiated portfolios and stakeholder sets. So in having to deal with a market and a year that's moving so rapidly and the velocity is just going kind of top speed, where are you spending your time right now? What is most interesting in terms of what you're really looking at?
Sure. So for us, one area we've been spending time on is thinking about kind of the long only or the beta one part of our portfolio. It's an area that's been challenging in the sense that more and more of all of our portfolios have been sort of pushed into US large caps. And partly as a result of that, it's harder and harder to source alpha in US large caps. So one of the areas we've spent time on is kind of figuring out, can we port alpha from other areas that are less efficient, such as small caps, global markets, maybe some quant strategies, over the betas that we'd like to port them over. And increasingly, there's an additional sort of risk that we're having to deal with or issue, which is that we might be entering a taxable
Yes.
world for endowments. And interestingly, some of the managers that we've been talking to on the portable alpha side also have some interesting tax-aware strategies that we might embrace, and there might be, in a way, almost blending of the two ideas in one approach.
Just as a follow-up, I know that that's such a massive change of really being very tax conscious and having to have that as an overlay to how you're thinking about it. What were those conversations like internally in terms of thinking about how to start vetting those strategies?
Yes, I think it's, first of all, it's important to kind of distinguish into sort of two separate steps. One is sort of what do you do in the near term, and you know, in the very near term about your situation today, and then thinking about how does the level of the tax justify a complete rethinking of the asset allocation approach, a rethinking of managing of assets in specific asset classes. I think it's still somewhat early to talk about the second one. There's still a lot of uncertainties, but certainly that, again, strategies that are tax aware, and particularly in areas like core equity or long-only equity, might become important elements of the portfolio for endowments. It's still a bit early to tell that.
Vincent, how about you? Where are you spending a lot of your time right now?
Okay, I mean, there are two things that, we're focusing on. Number one is, obviously, we talk about, the de-dollarization, that has been a big topic, with our clients. So with that, we're very actively, looking for, anything outside the US dollars. So euro has been, one of the big talking points. So we're very actively, looking for, things to do there. To a lesser extent, Japan as well. But however, we do have some issue, with the fundamental outlook, with Japan. And then one other thing that we've spent a lot of time on quite recently is for the April month, as I mentioned earlier, a lot of market neutral strategy hasn't been working as well as we thought it may be. So we are very actively, reviewing our portfolio, tracking, what works and what doesn't work, and if it didn't work, what happened. I mean, if you think about, what happened in April, now look back, to that episode, it almost like, nothing happened. But during the month, we had loads of phone calls. A lot of clients phone up and say, like, oh, do we need to sell everything US dollar now? What can we do? And in fact, some of the strategy, we thought, was working better. It didn't work as well. And then we asking ourselves questions of, okay, right, maybe, if things are not working, then we don't need to have it. So the old wisdom is, we need to have a really well-diversified portfolio. But now, we really need to think about, individual opportunity sets very carefully. I mentioned about the liquidity and leverage, before. I think those two aspects are absolutely paramount, especially in today's market. I still believe, something worse, can happen. And I'm sure, people have seen, some talks about, the ultimate, carry trade unwinding. We've seen a bit of that, in 2023 August. And we are trying to position, what if that autumn will happen again. And this time around, it's not just a brief monthly V-shaped recovery, but a more prolonged unwinding of assets. So we're trying hard and thinking hard, how we can actually make our portfolio more resilient if that happens.
Okay. And Todd, 700 billion is a huge number. I don't even know how you start parsing out your time, but what are you looking at right now that's interesting?
Right. So our clients, they tend to look, at the moment on the private credit side, they tend to look more towards asset-based lending. And there's a couple things to keep in mind. The first is in alternative assets and liquid assets. There's a lot of alternative managers here and also allocators looking for alternative managers, particularly on the liquid side. It's very difficult to allocate away from obviously one strategy to another. It's not like rotating from triple Bs into single Bs. A lot of that is driven by the fact that these managers traffic in level 3 assets, and they have lockup vehicles or even evergreen vehicles that have very limited liquidity that makes it difficult to reallocate as quickly as one can in the public markets. That's number one. The second thing to keep in mind is that rotation tends to come in the form of incremental addition to portfolios, which is something I referred to earlier. The third thing to keep in mind, and this is for a lot of the GPs in the audience, if you have the institutional community rotate or increasing their allocation to, and I'm just using asset-based lending as an example, while that might only be 5% of their portfolio or 3% or whatever, as they grow from 5 to 7 or from 7 to 10, that might mean that 100% of their commitments in that given year will go to asset-based lending, for example. And so when we think about tactical rotations in the alternative space, there's a lot of dynamics that go into it, and there's a lot that has to be maintained. But that's a long-winded answer. The short answer to your question is asset-based finance, specialty finance is all the rage at the moment. What it means, that's a whole different panel that we can spend time talking about.
So we've talked a little bit about different forms of risk you guys all just have to navigate now, and I don't think that we can talk about rotation or frankly markets in general this year without talking about risk squarely. So are there any new and emergent risks that you guys are dealing with, or are we really just thinking about different forms of traditional risk that we all kind of know how to gauge and measure, and it's just come in a different form? Vincent, do you want to start?
Sure. So I think this morning, we had a breakfast session. I think that was a very interesting. So one risk we've been talking about is all the multi-strategy, big performers, that getting too big, level up too large. I suspect the April month, part of the chop, the pace and the movement, of the job of the market is something to do with the degrowth, of the multi-strategy. And if you think about what happened to that the whole April month, I mean, what if sometimes we do ask the questions of what if President Trump didn't come out and say, look, we're going to delay the tariff by for another 90 days. I think if you look back to that point, the market was so ready to get another leg down, and I think that is a real risk. So what if that degrowth continue? What if all the multi-strategy has been the buyer of the market, and all of a sudden they put in all the capital, and that trigger everyone else to do the same. I wonder what might happen. I don't know. I mean, but that's truly is something we haven't seen before.
And Todd, you initially talked about jurisdiction, rule of law, like regulatory risk. Do you see anything new and emerging on that front, or is it really kind of different chapter, same book?
Well, look, I think that you mentioned something about, so in your prior question to Vincent, you mentioned, is it a different risk or is it the same risk just repackaged? And I have to say I totally disagree with that. I think that on the alternative side, I think that the risks appear similar, but they're not. And we can talk at length about that. I think being able to control your assets, that shows a very different, it expresses a very different risk than a liquid asset that where one hasn't that control. It's agency risk is what it is. But look, I think that, I think there's a wholesale change into a different book,
Yes.
Shannon, not a chapter of the same book. I mean, it depends how big the book is, right? If we're talking about the book of investing, then, but if liquid investing is the book, I think that there's a wholesale change, or at least expansion into a different book. And the other thing I think worth mentioning briefly is on the alternative side, again, within that book, there's a growing chapter.
Yeah.
And that chapter, what used to be, the first chapter was locked up vehicles. And the second chapter, which is getting bigger, are evergreen and liquid vehicles.
Yeah, we might have written a couple of volumes just in the first 6 months of this year. And Boris, you hit on the taxation issues. Anything else that Bowdoin is thinking about from a portfolio risk perspective?
I guess this, again, we often think about manager level in addition to asset allocation and kind of geographic. At the manager level, I think it's interesting to think about how the whole industry will face the issue of kind of embracing technology, embracing artificial intelligence, staying kind of relevant in a very rapidly changing world, not just from a geopolitical and financial sort of perspective, but also from a technological perspective. And that means evolving your organization. It means taking on new skill sets. It means sort of embracing data and analytics in a broader way. So I think that's one of the ways in which we're kind of thinking about our managers over the next 5+ years. Are they the kinds of organizations that are able to adapt to this or not?
Yeah, in our own organizations. I think that's
and our own organizations, very much.
Very true.
Yeah.
How about, let's almost flip this on its head. What are you not rotating out of? What are you, maybe in some cases, doubling down on? And I'll start with you. No rest for you.
So there are there's one area, interestingly, that I think that differentiates our portfolio from many of our peers, and that's we invest quite a bit in the global macro space. And we think that that's one where we are sticking to, maybe even increasing our focus on. We think it's very relevant in today's world, partly because a lot of the volatility is effectively being pushed into FX or rates. And so the ability to kind of both monitor and manage that risk is important. And then also just because there are a lot of opportunities because there's dispersion between fiscal policies, monetary policies, trade policies globally, and that's creating interesting opportunities, but also risks that you need to manage. And within that, we embrace equities as part of that, including some thematic or individual equities. A lot of people think that falls outside of macro. We think that there are long periods where even from a macro or top-down perspective, the right asset to own is equity. So excluding that would be a mistake.
Vincent, what are you holding dear in a market like this?
Sorry, I think the question is not what not to rotate.
What are you not?
Yeah, so I think quite recently I've been hearing a lot of people have been starting talking about private credit. Has been too crowded. Too much assets. Maybe a bubble and so on and so forth. I think it's something we're okay with for now. As long as you know what you're buying. I think as long as the assets are as of high quality, and the economy is doing fairly okay. So I feel quite comfortable about that for now. I know some people has been talking about okay, right, if we don't buy private credit, should we be considering alternative credit instrument, ABL, or so on and so forth. I personally, I think I still like to stick to something simplistic, something simple, and as I mentioned, it's important to be able to know what you have, and maintain the liquidity to a certain extent. So I think I'd much rather not to do too drastically, make that part of the portfolio changes for now. Yeah.
Sure. Yeah. So I think in the institutional community, and look, I'm a credit person, credit guy, but I have to give a shout out to private equity. I think that there are a lot of mumblings in the institutional community, and I think that's kind of made its way into the press, about the bloom coming off private equity's rose and Yale selling its portfolio and all of it. I don't believe that. I think private equity is going to be a core fundamental alternatives allocation. Might institutions trim a bit, recognizing that perhaps the connection between public markets and private markets are not as separate as they might have thought? But I think that's something that I think private equity is here for forever is a long time. But certainly, while I'm alive, which isn't that much longer, I agree. But anyway, but I think that's something that institutions are really going to be focusing on.
Boris, you kind of opened this can of worms, and I want to go back to your technology point because I think it's highly relevant, and it's not necessarily focused on your portfolios per se. But if you're willing to share, I'd love to hear how each of your organizations are embracing AI at this point. If it's all in, let's see where this can take us, or is it more measured? In some cases, before I started at iConnections, I was at a bank, and they were like terrified of it. And I've been shocked by how rapidly it's moved to an adoption phase and a very, very deep embrace. So I'm just curious, at StepStone, how do you guys think about incorporating AI into investment or operational processes?
AI specifically or technology generally?
Either, actually.
Yeah. So I'm being coy. We haven't really incorporated AI as of yet. It's a powerful tool. I'm sure we will. StepStone is a very technologically oriented firm, and we try to harvest as much data as we can, process it, analyze it, and return it to our clients in a way that's usable. So we're absolutely committed to technology. We're absolutely committed to data collection. As far as I know, we've yet to actually do anything in earnest with AI. I could be wrong, but for sure, I would bet on us looking to AI to do a bit with all the tremendous data we collect.
How about at Alps, Vincent?
No, not really, but I have seen some managers start using, some very innovatively, using AI. In one case, I hear some manager, they're trying to use AI to learn, all the well-known investor thinking, like Warren Buffett, all the well-known name, and then they're trying to adapt it like an AI agent as a consultant during the investment meeting. So I thought that was quite interesting. I mean, obviously, it's a new thing. I don't know how useful that is, but it sounds interesting anyway.
How about at Bowdoin?
So I would say we're early in terms of how we're implementing AI. I think at Bowdoin specifically, I think we certainly are using it the way that many others are using in terms of analyzing documents and transcripts and summarizing data and looking for sometimes even kind of interesting ideas through the lens of AI. I'd say where we're starting to be more focused is just hoping, talking to our managers about how they're using it and even thinking through what would be required over the many years for their processes to embrace AI. Because in some cases, particularly with some more fundamental managers that are very qualitative, it would take quite a bit for them to get to that stage.
So last question, we only have about a minute left, and we realize that among these three gentlemen, I think they've basically worked in every single LP vertical across the globe, and would just love a piece of advice that you have for up-and-coming allocators about how to just ignore the noise in a market like this and really stay focused.
So one idea would be to study market history. I think we often just think that markets will be the way they have been recently, but sometimes past analogs are actually a more useful framework for where we are today.
I think for us, whenever you see so much uncertainties in the world, the best way to do is to stick to the valuations. So look at all the valuation matrix and then stick to it. that's the only thing you know best.
You have the last
Look, it's
word.
going to sound cliche, but the best allocators I've seen in my career are the most disciplined ones. That's what it comes down to as far as I can see.
Fantastic. Well, that's the perfect note to end on. Please join me in thanking Boris, Vincent, and Todd, and enjoy the rest of the conference. Thank you.